Much for all those details. On to the steel sector now, and financial year 2018 is expected to be much better than the year that's gone by. Steel companies say one big opportunity will be a 7 to 8% pickup in demand that they expect, but they also add that to cash in on this opportunity, Indian steel makers will have a lot to do. CNBC TV 18's Kevin Lee, Kritika Saxena bring us this report.
Reduce debt, consolidate operations, and grab any spike in demand, however small. These are at the top of the list of things Indian steel companies say they will have to do if the sector is to escape the slow growth cycle that has plagued it through FY17. In this regard, there is some hope, because in spite of global economic volatility, there have been some signs that domestic demand at least will see some revival over the next 12 months.
The largest demand drive is happening only in India, more than 5%, and we are expecting more than 7 to 8% growth. What we should be careful of that mostly this demand should come, the supply should come from our companies.
The steel demand for FY18 is expected to be in the range of between 4 to 5%.
4 to 5%?
Yeah, it is more than last year.
Okay.
So with that, things will be better in FY18.
To grab these opportunities when they come knocking, however, steel companies will have to expand capacity, which means more investment, and that will happen only if balance sheets are deleveraged. Work on this is already underway. Tata Steel, for instance, says it has a plan in place to reduce its debt burden from the current 66,000 crore rupees.
We are back to a normal level of spending, and we think our cash flows will be better than that, and that should help us bring down the debt. But how much, etc., I wouldn't like to comment just now.
Okay, fair enough. As far as the European operations are concerned, I understand that you wouldn't want to go into the details, but there have been some reports, Naren, on ThyssenKrupp pulling out of the likely discussions and the tentative discussions with Tata Steel. Can you tell us or give some clarity, are the discussions with Thyssen still on?
The discussions are still on. I think there were some comments from the unions in Thyssen, but as far as Thyssen is concerned, the management of Thyssen and management of Tata Steel continue to talk to each other.
JSW Steel, which carries a debt of 43,000 crore rupees, is also in a similar place.
Our debt to EBITDA was 4.01. So we wanted to bring it down below 3.75. That is the guidance which we have been giving. So debt to EBITDA is 3.75, debt to equity is 1.75. So within these two ratios, we would like to expand our capacities, both greenfield and also brownfield, and also do acquisitions.
JSPL, which has managed to sell a part of its non-core assets, has brought debt down to 47,000 crore rupees so far and has no plans to call it quits.
We have already divested all our non-core assets, and so our accounts are normal. And in the next few months, we want to regularize everything, and things are only getting better.
Okay, no plans to sell the steel business?
No, we are not there. We are in the business of selling steel, not steel business.
Be that as it may, the reality is that steel companies will continue to struggle as long as global metal prices remain volatile. And unless Indian companies can rise to the occasion in terms of expanding capacity and shoring up financial health, the opportunities around the corner may pass them by. In Mumbai, with Kritika Saxena, Kevin Lee.